Investment banks are warning investors that the worst may be yet to come as a week-long sell-off that has pushed major indexes to the brink of bear market territory intensifies. If corporate earnings continue to disappoint as the Federal Reserve begins raising interest rates, some experts predict the S&P 500 could fall another 11%. The daring economic operations of billionaires have an impact on this habit. What impact will have this on small-time investors? Before we continue with the video, make sure to subscribe to Dinero Association and hit the notification bell so you don't miss anything from the latest in financial market and cryptocurrency. The ultimate hedge is happening, and billionaires are ruining the stock market. For one reason, the wealth gap has been widening for decades. Billionaires are experts at keeping their money safe and growing their fortune. However, ordinary people like you and I can see how millionaires accumulate wealth through public SEC filings. In recent months, the vast majority of top-tier fund managers and billionaires have been hedging their fortune against the possibility of a US stock market meltdown. The focus of this video is on this topic. Given pandemic-related global upheaval, the threat of rising prices, and the influence of central bank policies, hedge fund managers expect plenty of investment opportunities in 2022. According to sources, uncertain market circumstances are expected to increase market dispersion, which is exactly what hedge fund managers need to generate alpha. Because the average hedge fund manager underperforms the S&P 500, most investors believe hedge funds are poor at money management. However, more information is needed before such a conclusion can be made. The great majority of hedge funds are uninterested in outperforming the S&P 500 because their main goal is constant capital growth. During the dot-com bubble, the S&P 500 outperformed hedge funds by a significant margin, but the S&P 500 dropped while hedge funds barely changed when the bubbles burst. A similar circumstance occurred during the 2008 recession. The average hedge fund lost about 22% of its value, while the S&P 500 lost more than 50%. Fund managers' fixation with alpha causes this to happen all the time. The risk-adjusted return of a fund is measured by alpha. While it's great to make a lot of money during a bull market, it's meaningless if your gains are gone in a few months. Billionaires have recently begun to hedge their investments against future market drops. The fact that valuations are at all-time highs, inflation is out of control, and the Federal Reserve is committed to raising interest rates and eliminating quantitative easing, or the Fed's bond buying program, is no news. Market values are intricately connected to interest rates, and a rise in rates might quickly put the market at a standstill. Elon Musk, Cathie Wood, Ray Dalio, Michael Burry, Bill Ackman, Charlie Munger, Warren Buffett, and Chamath Palihapitiya have all taken steps to protect themselves from a market downturn. Position sizing ultimately determines market hedging. Market timing is notoriously tricky, and you should never bet a large portion of your net worth on a market decline. You should set aside a small portion of your portfolio as a hedge against your long position rather than investing altogether in short-dated options or shorting the market. You can liquidate your hedge position and use the cash to buy equities for long-term gains in the event of a market crash. Bill Ackman, a hedge fund manager with over $13 billion in assets under management, recently began a small bond short position. Ackman recently explained why he believes the Federal Reserve's plan to reverse course is overblown. While it is widely accepted that the Federal Reserve will raise interest rates 3 to 4 times this year to contain inflation, he continued, the market anticipates 25 basis point increases. The underlying elephant in the room is the Fed's apparent lack of credibility as an inflation fighter and the question of whether 3 to 4 rate hikes would be enough in that situation. The Federal Reserve may restore its credibility by launching a surprise 50 basis point rate hike to shock and awe the market and demonstrate its stance on inflation. Bill Ackman is effectively pleading with the Federal Reserve to raise interest rates for the sake of the economy. Ackman is infamous for manipulating the market, and this tweet could be another example of his doing so to boost the value of his short position. Hey, take a breather there for a moment. If you have not yet subscribed, please click the subscribe button to ensure that you don't miss any of our videos. A partner and co-portfolio manager at New York-based credit specialist King Street Capital Management LP said, "A flat yield curve signals that inflation will compel central banks to slow their economies, leading to more dispersion. We want it to happen because credit dispersion results in winners and losers. There should be some volatility in the market, but not too much." According to Mr. Goldschmidt, many companies are focusing their efforts on COVID-19 affected industries like offices, urban hotels, and department shops, which are currently undervalued but are expected to rise in value over the coming years. Sources in the hedge fund industry expect large inflows of capital in 2022. Based on reports, several hedge fund strategies are anticipated to perform well this year, including relative value, long-short equity, long equity, event-driven, merger arbitrage, convertible bond arbitrage, trend following, and unique purpose acquisition businesses. Sean Cudd, President and Co-Chief Investment Officer of Palm Beach Gardens, Florida-based Lighthouse Investment Partners LLC, a multi-portfolio hedge fund with $14 billion in assets under management as of December 31, said, "This year we see opportunities across nearly all of our strategies." Lighthouse's trading teams manage a variety of hedge fund strategies, including global relative value, discretionary macro, equities, and opportunistic trading. As a result of market conditions, hedge funds will be able to generate more alpha in the future, according to Mr. McGood. Right now, we've got a lot going on in our pipeline. In the second half of 2022, we may expect to witness an increase in the number of visitors in person, he said. This year's demand for hedge funds is primarily driven by institutional investors concerned about high stock valuations and low fixed income returns. As the Federal Reserve prepares to raise interest rates, investors have found it challenging to invest in long-term government bonds in recent years. What do you think about this video? Type your comments below. We are Dinero Association, your partner in building wealth. Don't forget to like and share.